So now we continue part 2, and we are still talking about perfectly competitive market. Okay, no need to talk about this. Okay, in this slide, the main idea is to show when the firm has to stop production and maybe get out of the market. Definitely when firm makes losses. I want to go back to this slide again, which shows that when price, this is a firm, this is one firm. So when price is at the bottom of average total cost, so in this situation and at this point, this is break even, which means the company is making no loss and no profit. But for this one, as you see, the market price went down, and because of this, the firm started to make losses because the price went lower than uh, the average total cost. So this is the average total cost. Now we will show whether the company has to stop producing at this or it needs to get out of the market. To determine whether the company needs to get out of the market, we recall the uh, the curve of average variable cost. So we'll go back to our slides again. So this is what we are interested here, when the firm should stop production or get out from the market. So this is what we are interested in. So the firm must stop production and shut down production or get out of the market when price is less than average variable cost. And we can show this graphically, and we will do it step by step. So let us first assume that market price is at P1. And as you see, the market price is above all curves, all cost curves. So in this case, this company is making profit. And to determine what is the Q or quantity that maximizes the profits of this company, you go to the rule which says marginal cost equals marginal revenue. So this is marginal revenue equals price equals demand. So this is the point where marginal cost and marginal revenue intersect. So if you take a dotted line down and hit average total cost, so all this area is going to be the profit. All this area is a profit. I will erase this for the sake of clarification and analysis. So as we said, this is the profit. Assumption 2, what if market price goes down to P2? So this is P2. And as you see that the market price is touching the bottom of average total cost. So now we want to know where is the quantity that maximizes the profit. So if this demand curve is marginal revenue equals price equals demand, and our rule says marginal cost should equals marginal revenue, so this is the quantity that maximizes the profit. But in this case, there is no profit, no loss, because at this point, marginal cost equals average total cost equals marginal revenue. Now we are going to assume that the price will decrease further. And we want to know, or we know that when prices go down less than average total cost, the company will start making losses. But the question is when this company has to continue, even if it is making losses, and when it has to stop producing and even getting out of the market, shutting down the business, at which level of losses? So let us go to P3. So again, the price declined. This is P3, and this is marginal revenue equals price equals demand. And our maximum profit rule says that marginal cost equals marginal revenue. So this is price and marginal revenue equals marginal cost. And then we take dotted line that hits average total cost. Then so this is the bottom of average total cost, and this is the price. So average total cost is greater than the price, so the company is making this loss. And this is the quantity. So here, the company doesn't need to shut down the business or stop producing. And the idea here is that because the price, this is the price, is still greater than the average variable cost, which is this one. So the company can still be in the business and continue producing. So price is greater than, so price is still greater than average variable cost. This rule is in the previous slide. So here we still haven't reached this situation. But this situation, price is less than average variable cost. But in our case, the price is greater than average variable cost. And you know that variable cost is cost of paying salaries and utility. So whenever the company is still able to pay salaries and utilities and other variable costs, the company could still exist in the business. But we also noted before that there are also fixed costs. So this fixed cost is associated with average total cost because average total cost has two costs, variable cost and fixed cost. Now, because the price went down, we are more interested in average variable cost. Why? Because this average variable cost is connected and linked with level of production. And if you remember before that we said that for fixed cost, the company, whether it produces or not produces, it still has or still have to pay fixed costs. We call these fixed costs sunk costs. We go back again. So this is the sunk cost. So sunk cost is something that could be referred as or fixed cost could be referred as sunk cost because the company is burdened with it. And the situation where the price is even zero and no production, you still have to pay a fixed cost. So the company can continue in the market and strive with fixed cost or bear the fixed cost. But the problem is here, variable cost. Why it's a problem? Because if you don't pay salaries and you don't pay your utilities, the firm could be sued or brought to the court and could be forced to close the business and have bankrupt case. But as we said just now, that if the price is greater than the average variable cost, the company could be in the business and still produce. But the fourth, if we go to the fourth assumption, when the price is touching the minimum of the average variable cost, still the company can be in the market. But see how much losses making. So all this will become loss. So at this level, the company can still be in the business because the price at minimum, is still covering the variable costs. Assumption number 5, what if the price went down and lower than average variable cost? So as you see here that price or marginal cost equals marginal revenue. So all this from here to here is price is lower than the average variable cost, but it is all this area is going to be the big loss. Remove this again. But again, the main idea here is that as what you see here, that this price is lower than average variable cost. So in this area, price is less than average variable cost, so the company has to shut down business as it is mentioned here. Price is less than average variable cost and the company has to shut down the business and production. Okay, so at this or in this slide, it is just showing that marginal cost, the curve of marginal cost is in fact the curve of the supply or market supply. So all marginal cost curves for all producers or sellers in the market, if you sum them all, it will become a market supply. And the idea here is that marginal cost is addition of cost. So if this addition of cost is covered by addition of a price, and this addition of price will also cause addition or change in the production. So production and price and cost are all reflected in the market or in the marginal cost curve. That's why marginal costs becomes like a supply curve of the market. Okay, in this slide, another notion or concept which is economic profit. So what is economic profit? In fact, economic profit is different than accounting profit because in economic profit we include opportunity cost and implicit costs that we showed before. In accounting profit, we just put the costs, visible costs, taxes, interest, and so on. So we don't mention in the accounting profit any estimate of opportunity costs or invisible costs. And here we want to show what will happen to the movements of the curve because of other factors like income, like more advancement in technology that could cause movements of the curves. I mean market supply and demand curves. what this is going to have impact on uh, a firm that is exist in the market, and we want to explore if there is profit or loss. So let us start from this curve. So and start with level of price of 15. And as you notice that at this level of price of 15, the price is greater than average total cost. And this is where the marginal cost equals marginal revenue, because the price is also marginal revenue. And because average total cost is less or below the market price, and so this is going to be the profit. So this is initial analysis. Now, what if there are factors that affect the production side or the supply side and will make supply curve to move to the right, showing increase in the market production? Let us say the factor here is more entry of firms. So the more firms come to the market, the more production is going to be in the market. So this is more production, and this will make supply curve to move to the right. So when it moves to the right, we will reach a new equilibrium, and at this new equilibrium, the price equilibrium, because it's going to be below the initial one, so the market price declined and reached 10. What this happened to profitability of the firm in the market? So as you see that this market price went down to this new level, and at this new level, you will find that average total cost is same as market price. So no profit or loss is resulted here. And we call this level as a break-even level or point. Let's go to another case. Again, what will happen if uh, changes happen to the demand curve? So, for example, reduction in income. So, reduction in income will lead to lower consumption, so lower demand, and this will lead demand to move to the left. So again, we'll do the same analysis. If we start with price level of 10, we will notice that this price level, and this is the initial equilibrium. So these are initial supply and demand curves. So at this level of price, you will find that this company was in fact in break-even point where price equals average total cost, so no loss and no profits. But now, because of the shift in the demand curve, so the demand curve went to the left, and this resulted a new equilibrium point, which is here. So the price or the equilibrium price declined to $7, and at $7, you will find that this company is now making losses. Why? Because now price is less than average total cost. And if you want to know what level of production, you need to equate marginal revenue, the price is marginal revenue, with marginal cost. So this is the level of production. And all this is going to be a loss. If I want to make this company shut down the business and get out of the market, I can show by drawing average variable cost like this. So here the price is, this is the price level, and the price is less than average variable cost, as you see. So this company has to shut down the business and get out of the market. Okay, the last thing we need to talk about is, yeah, some concepts, the difference between productive efficiency and allocative efficiency. So productive efficiency uh, exists when production in the market are are at the lowest possible cost. So all firms in the market produce at the lowest possible cost. So this is for one firm. So if we uh, sum all the lower level costs, this is going to be the market cost. And production in the market are made at the lowest level of costs, lowest possible level of costs. And this curve is showing what we just mentioned. So this is average total cost and the price. All companies are producing at this price in the market. So this is the price in the market. And at this level, this is P2. This is P2, or this price is the price that achieves productive efficiency. And this quantity that achieves productive efficiency. Why? Because prices are at a level where production is at the lowest possible cost level. Allocative efficiency, the only thing that we need to say here is uh, firms produce exactly consumers what consumers want, or get the maximum benefit out of it. So you allocate resources to produce production where this production fulfills benefits of the consumers. So here we can say uh, production are produced at level of production where marginal benefits equals or equal marginal cost. So marginal benefit is marginal utility, and marginal benefit is marginal utility from the consumer side, and marginal cost is from the producer side. Of if those indicators become equal, then all resources that led to production will fulfill exactly the benefits of consumers. By that, we reach the end of this topic, which is about perfectly competitive market. And that's it. Thank you.